It's Wednesday, and that means it's time for your midweek market update. So I'm going to throw up a little chart here. At the far side of this chart, you can see those larger spikes moving up, those candles moving upward. Those were the days where rates very suddenly got better. And that's about 2 or 3 days after that happened. The news really started hitting the market. Everyone was posting on social media. All the ads and stuff you're seeing are rates are getting better, rates are getting better. They actually got worse then for a few days. And now they've slowly been creeping back up to those levels that they obtained for a brief while on those couple of days in early August. So the markets move fast, and so the news is always going to be behind the times. I've said that many times. So but those were 2 great days. We're in a good point right now, but you can see on this chart that 101 is an absolute ceiling for us. We actually closed yesterday at 101, so we actually got there and closed, first time in a long time. And then today opened up a little bit above it, but then that candle's moving back down. Does not look like we're going to close at or above 101 again. So it's definitely acting as a ceiling, and we're looking for something to push us outside of that. Now, I want to show, as part of this video, someone that I follow, a bond guru named Bill Bodner, has something very interesting to point out about inverse bond yields. So think about a CD. If you're going to invest money in a CD, if you're going to park your money there for a year, you expect a higher return than if you parked your money there for just a 3-month CD. Bonds are the same. A 10-year bond should pay a higher yield if you're going to park your money there than a 2-year bond. But that's not the case right now, and it's not been the case for a while. Those things are flipped, and that's why you'll see things like ARMs are not attractive right now, adjustable rate mortgages, because those short-term bonds that those ARMs are tied to are actually worse than the bonds that control the 30-year fixed mortgages. Same thing with the 15-year and the 30-year mortgage. Not seeing the benefit to going down to a 15-year term right now that we typically see in interest rate. And this is all because of the bond yield curves being inversed. He'll talk about that. He'll also talk about what that means we might see in our future.
You hear a lot of debate, yield curve inversion. Let's remind ourselves, the 2-year note is 386 and the 10-year note is 382. They're upside down. These have to disinvert. That's what a normal yield curve is. And the way the yield curve works is like it's basically telling you when it's inverted that the market, that the economy is probably headed towards a recession. It means that short-term rates need to come down, especially this shorter-term rate. And so when you get the yield curve inversion, you don't get the recession until after it disinverts. And we are now on the precipice of it right now. And I want to show you a little history. Before 1990, you can see we get a yield curve inversion. This is, again, where we are today. Short-term yields are higher than long-term yields. When things normalize and you have a normal yield curve and 10-year note is now higher than the 2-year note, then you get the recession. Happens again before the recession of early 2000s. You can see here we get yield curve inversion. It disinverts shortly thereafter, a recession. It even happens before the Great Recession. And you could see we had this long, historically deepest yield curve inversion, except you got to go back to the 80s. And then it's going to disinvert. Now you can see over here, you say, wow, a lot of weird stuff.
Okay, so thanks for totally nerding out with me there with Bill and what he was talking about with the bond yield curves. It's food for thought. Who knows what the future holds? I do know that rates are at a place right now that we have not seen them at since the first quarter of 2023. So it's been a year and a half basically since we've seen rates where they're at right now. Get it while the getting's good. And if you have any questions, you know where to find me.